Spending the People's Money. Module 3, Spending the Resources. Module 3, Budget Execution Events Involving Spending Resources. This is the third module in a series of 3 modules on spending the people's money, otherwise known as budget execution. In modules 1 and 2, we discussed receiving resources and then controlling and distributing those resources. It's only now, in Module 3, that we finally reached the stage of actually spending the money. Spending events in budget execution are divided into 4 basic events. Event number 8 is the obligation. Event number 9 is the outlay. Event number 10 is expiration. And event number 11 is cancellation. We'll first focus on the obligation and outlay budget execution events that occur during the period of availability. As you will see, these events are somewhat intertwined. Then we will cover the expiration budget execution event at the end of the period of availability, the outlay events that occur after expiration, and finally, the cancellation event at the end of the process. After that event, we can consider the budget execution process essentially ended for that fiscal year's appropriation. When we have concluded this module, we will have covered all 11 budget execution events we set out to discuss. Before we get into the details, let me point out a budget execution event that, though it doesn't count as one of the major 11 events, should still be mentioned. That event is the commitment. A commitment is somewhat like a pre-obligation or a reserving of funds to be obligated. Some organizations use the commitment and some don't. If your organization uses commitments, you should be aware that the event occurs after funds have been distributed, that is, apportioned, allotted, and allowed, and before funds are obligated. Since the use of commitments is optional, it's not included in the list of major budget execution events, and we won't spend much time on it. So, let's begin the module with budget execution event number 8, obligation. As we learned in the introduction, OMB's definition of an obligation is a binding agreement that will result in outlays immediately or in the future. The obligation event is the focal event for budget execution. We know this because of all those statutory control and distribution steps that necessarily precede the obligation event. We also know this because the basic concepts of appropriation law, purpose, amount, and time are focused on whether an obligation is proper or not. Many of the rules we have discussed apply at the obligation event. Let's review some of those rules. We know a valid obligation must meet the basic principles of appropriations law. It must be for a purpose established in law. The purpose statute, which is also codified in Title 31, specifically at Section 1301, tells us that we can only apply appropriations to those objects for which the appropriations were made. In other words, we can only spend the funds for the purposes Congress identified when they appropriated the funds. The budget execution steps leading up to the obligation assist in meeting this rule. For example, broad purposes are categorized by the Treasury Appropriation Fund symbol to which the funds were appropriated. OMB may further identify amounts by purpose in the apportionment process by establishing Category B amounts. And the agency further delineates amounts by purpose in issuing allotments and allowances. But it's important to note that the final determination that a proper purpose is being met still has to be made at the point of obligation. It must also be within an amount established by law. It must be obligated within the time period, otherwise known as its period of availability. This purpose has to meet a bona fide need of the period for which the funds were made available. The bona fide need rule appears in Title 31 at Section 1502. This is a very important rule in budget execution. Congress is telling us we can only spend an appropriation to meet a legitimate or bona fide need of the year for which the appropriation was made. The final determination that an obligation meets a bona fide need of the period for which the funds were made available also has to be made at the point of obligation. But there is another hurdle in making a valid obligation. Note the requirement that funds must be obligated consistent with Section 1501 of this title. What does that mean? After you have all of the budget execution events we discussed in Modules 1 and 2, especially the control mechanisms of the apportionment, allotment, and allowance events, you also need to properly document the obligation. Section 1501 of this title, otherwise known as 31 U.S.C. 1501, sets out the requirements for this. Why do you need to properly document an obligation? Well, before 1954, there was no uniform meaning of the term obligation. Agencies might record bogus obligations where none existed just in order to keep funds from lapsing. The appropriations committees in Congress could not obtain reliable obligation amounts and therefore did not know what agency needs actually were. Because of this, Congress enacted Section 1311 of the Supplemental Appropriations Act of 1955. This section has come to be called the Recording Statute and has been codified in Section 1501 of Title 31 of the U.S. Code. The Recording Statute establishes certain standards for the proper recording of obligations, thereby ensuring federal agencies record only those transactions that meet those specified standards for legitimate obligations. To record an obligation, an agency must have documentary evidence of a binding agreement, like a contract. Note that this agreement has to be for a purpose authorized by law and executed before the end of the period of availability for obligation. A loan agreement, an order required by law, a grant or subsidy, a liability from litigation, employment of persons, public utility services, or other legal liability. You can't record an obligation in the absence of documentary evidence of one of these. On the other hand, if you have such evidence, you must record an obligation. Different types of obligations require different forms of documentation. For example, if you want to purchase something, you might use a purchase order, or HHS Form 393, and HHS 26 for printing, a travel order for travel, a PSC 59 for miscellaneous obligations, or a notice of grant award for a grant. Each of these forms of documentation has a reference number for identification and includes accounting information. This identification is necessary for audit purposes to be able to properly track an obligation of funds. Let's review the type of accounting information that's needed. This should look familiar. It's the Global Budget and Accounting Classification Structure, or BACS code, we saw in Module 2. Because one has already gone through the budget execution steps to distribute and control the funds, most of the accounting information has already been established. The fund, budget fiscal year, organization, budget activity or program. The obligation needs to add the object class. The object class is the statutory requirement to identify the type of obligation being made. Is it for pay? Is it a grant? And so forth. The accounting event here identified by the SGL account is the obligation of funds. So, where does the outlay fit in? In order to properly understand the outlay event, we need to take a closer look at the obligation event. From an accounting perspective, the obligation is broken down into 4 basic sub-events. You order something, but you haven't received it or paid for it. You receive something you have ordered, but you haven't paid for it yet. You pay for something you have not received. Or you receive something you have ordered and you have paid for it. Note that the last 2 of these obligating events involve payments, and the first 2 do not. The last 2 events that involve payments are referred to as paid obligations or outlays. And that brings us to budget execution event number 9, outlay. The definition of an outlay in GAO's glossary of terms used in the federal budget process is the issuance of checks, disbursement of cash, or electronic transfer of funds made to liquidate, that is, pay, a federal obligation. So, an outlay is basically a paid obligation. Because these distinctions are very important when recording obligations in the accounting system, let's take a few minutes and explore them in a bit more detail. The first obligation event involves an order that has not been received and has not been paid. Perhaps your office ordered a particular piece of software that you need and you haven't received it yet. This is referred to as an undelivered order, obligation, unpaid. The second obligation event involves an order that has been received and has not been paid. Let's say you received the software you ordered, but it hasn't been paid for. This event is referred to as a delivered order, obligation, unpaid. Accountants need to categorize these events correctly. If an order has been received, then the government now needs to pay for the order. Accountants call these accruals or accounts payable. And because of prompt pay requirements, it's very important that each of these events is documented properly and in a timely fashion. Both of these obligation events are classified as unpaid obligations. The third obligation event involves the payment, that is outlay, for an order that has not been received. There are cases where the government advances money for an obligation before it receives anything. For example, grant payments are typically advanced before an expenditure report is filed. These would be classified as undelivered order, obligation prepaid, or advanced. The fourth and final obligation event involves the payment or outlay for an order that has been received. This event is a delivered order, obligation paid. Going back to the software example, once the order has been delivered and the bill has been paid, the obligation would move to this final status. It's important to note that all four events are technically classified as obligating events. If you wanted to know your total obligations, you would add up the balances in all four events. But if you wanted to determine how much your outlays were, you would only add up the balances in the paid obligation categories. In fact, in budget execution, we're primarily interested in only these two distinctions, whether obligations are paid or unpaid. This distinction will become much clearer shortly. Let's recap. So far, we have discussed the budget execution events that describe spending during the period of availability. We have discussed the concept of the obligation, what constitutes a valid obligation, and how paid and unpaid obligations are distinguished in the accounting system. But even though the period of obligation may have ended, spending, in the payment sense, continues after the period of availability has ended. What budget execution events are important after the period of availability is over? Well, first of all, we need an event that stops the availability to obligate. We call this event expiration. Expiration is budget execution event number 10. The final, or 11th, budget execution event we will discuss is the cancellation. Let's set the stage a bit by looking at an annual appropriation, our most prevalent form of spending authority. By law, annual appropriations have a life of 6 years. They have 1 year to obligate funds and 5 additional years to pay for those obligations, make adjustments, and so forth. 6 years total. Why 6 years? Prior to 1990, all appropriations were tracked for 2 years, after which all obligated balances were moved into merged or M accounts. Unobligated balances were moved into merged surplus authority accounts. These balances remain available for payment indefinitely in these M accounts. The Air Force got into trouble with Congress in 1989 for using roughly $1 billion from their M accounts to correct problems on the B-1 bomber, prompting Congress to do away with the M account. Public Law 101-510, requiring the 6-year lifespan, was passed in 1990 based on congressional concerns over Department of Defense use, or as some would say, abuse, of these M account funds. Every one of those appropriations has to be tracked by its account number, or TAFs, throughout the life of the appropriation. Once obligations are paid, we no longer have to account for them. Let's take a look at how this works graphically. These 4 rectangles represent the period of availability of 1 fiscal year divided into 4 quarters. It's during this period that the budget execution events we have discussed so far occur. We first have a resource that we control and distribute. We obligate some of the resources in quarter 1 and in quarter 2. Some of the obligations are paid in quarter 2. We continue to obligate in quarter 3, and some more obligations are paid. During quarter 4, we obligate the remainder of our resources, except for a small amount, and add a bit more paid obligations. When we reach the end of the fourth quarter, our period of availability for obligation ends, and the funds expire or lapse. This is the budget execution event we call expiration. After expiration, the funds remain available for 5 additional years in an expired status in order to pay off the obligations and make any necessary adjustments to them. Once this 5-year period is over, the funds are canceled and returned to Treasury. Cancellation is the final budget execution event. Once this occurs, the TAFS no longer has any balance and is closed. Let's talk a bit about status of resources. There is a basic equation of budget execution. Resources on the left side of the equation must equal the status of those resources on the right side of the equation. Here we can see that the status in each quarter equals the original resource. If this equality is always maintained, you can never spend more than your total resources. This basic equation continues throughout the life of the account. But what happens after year 1, after we have paid some of the obligations and the resources are reduced? Let's take a look at the status of resources at the end of year 1. Note that as the year ends, we have obligated almost all of the resources, and more than a third of those obligations have been paid. That leaves a balance of unpaid obligations and a small balance unobligated. This unobligated balance represents that portion of the original resources that did not get obligated before the period of availability expired. As we reach the end of year 1 and close it out, the paid obligations and the resources that paid for them go away, leaving only the highlighted portion to track in year 2. It's important to remember that our accounting equation stays the same in year 2. Resources still equal status of resources. The paid obligations of year 1 are deducted from both sides of the equation, the resources and the status of resources, thereby maintaining the equation in year 2. At the beginning of year 2, note that the sum of the obligated unpaid balance and the unobligated balance, collectively referred to as the unexpended balance, will always equal the resources in the account. You may hear these resources referred to as the fund balance with Treasury. During year 2, we would see more of our obligations getting paid, leaving a smaller unpaid balance, as well as the unobligated balance. When we close out year 2, we can see the amount remaining to account for in year 3. The first thing we notice about year 3 is that the unobligated or white portion grew. That means that some unpaid obligations that had previously been recorded were de-obligated. For example, perhaps a company could not fill our order for software because they had gone out of business. So we reclassify the obligated unpaid status as unobligated. Note that the total resources do not change. Merely the status of the resources has changed. That is, the white got bigger because the green portion got smaller. Since the account has expired, this unobligated balance cannot be used for any new obligations. It can be used, however, to adjust any obligations made in year 1 that were underestimated, for example. We call those upward adjustments. we can see that some more obligations got paid in year 3, thereby leaving us with a smaller balance to track moving into year 4. Note that in year 4, the white portion, the unobligated balance, got smaller. This indicates that some obligation from year 1 had to be adjusted upwards, perhaps because it was based on an estimate and the final bill came in a bit higher than estimated. Again, upward adjustments change the status from unobligated to obligated unpaid and do not affect total resources. Well, by now you can see the pattern. This continues until the end of year 6. When we reach the end of year 6, we have reached the end of the life of our account, and we need to close it out. We note that there's a little bit left that's unobligated, and a little bit that's obligated but unpaid. In closing out year 6, the first thing that happens is all unpaid obligations are de-obligated, and then all unobligated balances are canceled. This action returns the funds to Treasury through our final budget execution event, cancellation. When the funds in a TAFs are canceled, the resources are reduced to 0. So, at the end of the life of the account, our equation is maintained. What happens if a bill comes in after the funds are canceled? Congress also allowed for this eventuality in the 1990 M-Account legislation, codified at 31 U.S.C. 1553, by permitting such bills to be paid from current year resources. This authorization permits payment from any current appropriation account of the agency available for the same purpose, not to exceed 1% of the total appropriations for that account. For those who prepare apportionments, you may recall seeing a footnote that states, pursuant to 31 U.S.C. 1553b, not to exceed 1% of the total appropriations for this account is apportioned for the purpose of paying legitimate obligations related to canceled appropriations. That footnote, which is required to be placed on most apportionments, is the direct result of the M-Account legislation. Well, this wraps up Module 3 on the budget execution events that make up spending the resources. We have followed the budget execution path from budgetary resources through the different statuses of resources. The control and distribution stage, covering the apportionment, allotment, and allowance, and the spending stage. The spending stage was further divided into the period of availability, during which we discussed the obligation and outlay events, and the expired phase, where we were introduced to the expiration and cancellation events. We found out that the obligation and outlay events, number 8 and 9, are more than just 2 events. They're a set of 4 events distinguished by whether an obligation is paid or unpaid. This concludes the modules on budget execution, or, as I referred to it at the beginning, spending the people's money. I recommend that you look at the video, Introduction to Budgetary Accounting. This video takes the budget execution events we've been discussing and shows how an accounting system captures them. Congratulations! You've completed Module 3. Now check out Intro to Budgetary Accounting.